What is up, YouTube, and welcome back to another Fridge Financials video. And in today's video, we have a lot of data just thrown at us from the Federal Reserve, with Jerome Powell speaking today on top of CPI data, and all this information is coming at us. We had jobs report last week. We have more inflation-related data coming out tomorrow, which is PPI, which is the Producer Price Index. But we're going to take a look at the CPI data, what Jerome Powell said, because he just finished up speaking recently, and what it kind of means from there. So if you're excited for today's video, make sure that you smash the thumbs up button, subscribe to the channel if you've not already done so, and make sure you turn the bell for all future uploads. So as you can see by this title in Yahoo Finance, inflation eases in May as consumer prices rise at slower than expected pace. Now, we've talked about this idea before about inflation, how it's the most killer thing in the economy and things are getting out of control and everything else. This is still saying that prices are still increasing, but the thing is that is something to make note of is that prices are increasing at slower rates compared to before, which means there's an easing of inflation. Over time, prices are going to continue to go up. Just as you look at the past 100 or so years, we always have inflation of, again, our goods and services increase in time. Gallon of milk was like $1 like years and years ago. Gas, same thing. So prices always will be going up. But the fact that this is talking about how the prices are rising at slower than expected means we're hopefully having a little bit of a slowdown of these inflationary pressures and these values here. So we're going to talk about the inflation data. We're talking about the CPI data, which is the Consumer Price Index. Now, the Consumer Price Index talks about essentially the price changes in consumers. Consumers are yourself, myself, and how prices are changing month over month, year over year, and everything else. So the Consumer Price Index remained flat over the previous month and rose 3.3% over the year prior in May. A deceleration from April's 0.3% month over month and 3.4% annual gain in prices. So what they look at with this kind of data here, you look at two things: month over month, year over year. So month over month would be from April to May, then the previous month would be from March to April, so on and so forth. And so what you'll see here is that the CPI data remained flat over the previous month, which basically means that from April to May, there was a flat 0% change in the CPI data, which again is that inflationary measurement to talk about cost of goods, services, and everything else. And it rose 3.3% over the prior year in May. So May of 2023 to May of 2024, the prices, according to the CPI, are of these commodities and everything else, are up 3.3%, which, even though you're saying fridge, that's still an increase in prices. Yes, that is true. But if you look at it, it's a deceleration from April. So April of 2023 to 2024 was up 3.4%. So that means that we have an increase still in these values of inflation, but it's 0.1% less compared to the previous month, which is good. And again, from March to April, prices were up 0.3% month over month, and now that they are flat, which is 0%, that means that there's a little bit of a deceleration, or it's slowing down, which is really, really good to see for sure. We don't like these numbers coming in higher than expected and keeping to increase. That's how you know that inflation is still keeping around, is kicking itself up, and all that kind of cool stuff there. Not cool for us, of course, but to me it's cool because it's just data, right? Lowest monthly headline since July 2022. A decline in energy prices led by a drop in gas prices. Very, very good to know, especially for the summertime. Contributed to the furthest downward pressure on headline CPI. On a core basis, which strips out the most volatile costs of food and gas, prices in May climbed 0.2% over the prior month. So from April to May, they're up 0.2%. Which again is still the lowest monthly core reading since June of 2023. And overall, they are up 3.4% compared to previous year. So the core inflation, the core CPI data takes out those volatile things like food, gases. So it takes those away because those ones are usually fluctuating a lot more. So the core takes out those really, really high extreme cases where things are going to be changing really, really quick month over month and everything else. Both measures were also cooler than April's data and lower than the economists' estimates. So the economists obviously take a look at the data and say, we're going to project this. Banks, financial institutions, those kind of things predict these kind of things. And when they come in cooler than expected, that's good. You don't want it to come in hotter than expected. You know, if they were looking at 3.5 and we got 4, that's insane. That means prices are going crazy, inflation is still around. It's absolutely wild. The CPI release for May is very good news for the Federal Reserve, and it is going to be even better now for the PCE price index, which will be released at the end of the month. The PCE is the personal consumption expense, and we're going to talk about how that relates and what they use for it, and we're going to look at some data there. Again, here's our inflation chart we have used previously in previous videos. As you will see, the high point was at 9%. Now we have gone from 3.5 to 3.4, now to 3.3. So inflation is not going to be just a steadily drop like it's nothing. You know, it's going to take some time. You're going to have these little bit of dips, going up, going down kind of thing. But overall trend is that we are having this decrease in inflationary values. Again, prices are still going up, so don't get me wrong on that one. But they're going up at slower rates, which is what we want. Okay, we want it to go up at slower rates compared to faster rates. As we know, inflation has been stubborn above the Fed's 2% target, which is what they were hoping for. I guess you can see before the pandemic, we were looking at about 2%. And it goes into here more and more and more. It's bumpy. Again, so the Fed officials have categorized the path down to 2% as bumpy, which again is going up and down, of course. On Friday, the Bureau of Labor Statistics showed the labor market added 272,000 non-farm payroll jobs last month, significantly more additions than the 108,000 expected, which basically means that we have a lot of hiring going on into our labor force. Wages also came in ahead of estimates at 4.1%, although the unemployment rose slightly from 3.9 to 4%. So the hiring data, the labor market data came out. I can't think of the name right now off the top of my head, but it came out and it showed it was kind of a mixture view because you have a lot of jobs going into the economy. You have a lot more hirings going on, as you can see here. So a lot more people have been added on to those payrolls here, especially, which is great. There was a slight increase in unemployment, nothing too crazy, which means that more people are retaining their jobs and everything else. But there was also this one part of it where it showed wage growth. And the problem that people might see with wage growth is that if wage growth is going up a little bit too fast, it could potentially lead to producers, to companies, corporations raising their prices to offset those because they got to pay their employees more. So to me, it was a little bit of a mixed one. It was good. Then it was kind of like, you look into it a little bit, it's a little bit more mixed. So more hiring is great. Still lower unemployment rate, which is absolutely awesome. But again, that wage growth, you got to be a little bit careful with that one because, again, if you have too high of wage growth, producers got to raise their prices up. Raising the prices up leads back to inflation. It's a vicious cycle of just craziness, right? Notably, the Fed's preferred inflation gauge, which is actually what they use more compared to the CPI and PPI, is the PCE. The year-over-year change in core PCE, closely watched by the Fed, held steady at 2.8% for the month of April, matching March. So in March was 2.8, April also 2.8. We're going to talk about that a little bit more later on. Investors now anticipate a range of 1 to 2 basis point cuts in 2024, down from the 6 cuts expected at the start of the year. And I think I covered this in a previous video also about how the market wanted 6. The Fed was looking at like 3 or 4. And as you can see now, we're going to be lucky to get 1 to 2, so market was pricing a little bit too much, seems like, but that's just, that's just what happens. The market predicts things. They try to price things in. Things happen, everything else. Following the data's release, markets are pricing in a roughly 69% chance the Federal Reserve begins to cut rates at its September meeting, which is up from 53% just the day prior. So this inflation data, this CPI data that came out, has raised the chance of us having a potential rate cut in September up 16% in just one day. Which means that people are more optimistic about the economy. People are more, hopeful that we're going to have rate cuts. Again, we're all looking around and waiting for those rate cuts to come into play. Mortgage rates, car loans, loaning money in general. With these high interest rates, it's very hard to do, and borrowing money. So a lot of people are watching to see when the first rate cut is going to come into play. And Jerome Powell has to play it careful because of this idea of if you do it too quick, you're going to have a huge drop off. It's what they call a soft landing. He's trying to figure out when the best time is to do it. Shelter prices remain sticky. Energy index falls. So it talks about how the costs for the inflation in print include the shelter index, which is up 5.4%, which is rents and everything else. Still a slight slowdown from April, which is good. The index rose 0.4%. Sticky shelter inflation is largely to blame for higher core inflation readings. We are still waiting to see further moderation in rent of shelter. We are confident that the CPI for rent of shelter will eventually downshift given the rise in rental vacancies, but the timing is still uncertain. So with all this data coming out here, again, it might take some time for you to actually see it impacting you in everyday life. Again, it's just right now what we're looking at here. So you maybe have not seen it just yet. This talks more about it. Energy prices fall, which is good. Gas prices fell 3.6 from April to May after rising 2.8 in the previous month. That's good. Love to see it. And this right here is the thing I talked about also. The food index increased 2.1% in May over the previous year, with food prices coming in 0.1% from April to May. So food prices are going up. And in my previous video about how I looked at data and said the economy was great, people were like, nope, food's more expensive, insurance is too expensive. Sure, fine. But here's the point I made in all those comments there. The index for the food at home came in flat over the month, while food away from home rose 0.4%. So if people are sitting there, and again, this is my take on things, this is what I personally believe, right? Is that if the food at home is not changing in prices from month over month, from April to May, but the food away from home, takeouts, restaurants, those kind of things, is up 0.4%, maybe we should start to focus on eating more at home, right? Save yourself some money, eat at home, those kind of things, might save some money in the long term here. And I've made that point before that people are still continuing to go out to eat lunch, dinner, takeouts, door dashing, whatever. And those prices are still going up faster than the food at home. So if you buy the food and you go home and make it, a little bit cheaper. So just, my 2 cents about how people are looking at things on how that works. The indices for airlines I heard went down a lot. You can look at the data yourself. If you want to, just Google CPI data May and it'll pop up for you. So that was a very, very good report. And as you can see here, the report came out at 8:30, and you got a huge volume, huge increase in the stock market for the day. Jerome Powell also spoke at 2:30, so that was a crazy little choppy market that we have right now. But still, overall, looks like the market's pricing in a really good report for the inflation data and everything else that came out. As you will see, September 18th, which is going to be what they were talking about in the article, they're looking at pricing in a rate cut of one rate cut about 58% now, and 5.3%. To be 2 cuts, so you're looking at combined 63.5% between these two here, and 36.5% keeping rates at what they are at. And again, prior to it, it was a little bit lower. So obviously, with this data coming in, showing this potential sign of cooling of inflation, people are going to start to get a little more optimistic about pricing in those cuts and kind of go from there. Again, our interest rates right now are between 5.25 and 5.50, which is again 5.25% to 5.5. They want to go down to about 5 or 5.25. So again, about a 25 basis point cut, or about 0.25%. They do it usually by that one. Very rarely do you see like 0.5 or higher, but so they kind of go from there. And you can also take a look at this chart here. Again, this is on the FedWatch tool, the CME group. And you take a look at probabilities. You can see how the market is potentially pricing in now at least 1 cut here, potentially 2 by December. It'll be interesting to see how that goes. Obviously, these numbers change every single day, so we'll be curious to see what happens for that one. And yeah, so what I want to talk about also is, as you will see here, we have the personal consumption expenditure price index, which is what the Fed uses more for data and to gather how inflation works. And this data comes out at the end of this month for the month of May. So we don't have May data yet because we have to go through June. And right now it's holding steady at about 2.7%. And the core, which takes out food and energy, has been holding steady about 2.8%, actually down from January of 2.9%. So this is kind of showing that feeling of, starting to slow down a little bit, hopefully inflation is cooling off a little bit. Prices are still going up, of course, but they're going up at a slower rate, which is, again, is a good sign that it's starting to cool off a little bit, even if prices are going up. And the other important piece of data, because we talked about a lot of data here now. We looked at CPI data. We've looked at interest rate probabilities. We looked at the market. We looked at the PCE data, which is what this is. We have what's called the summary of economic projections. Okay, so basically what it is that you're looking at the Fed. The Fed is looking at. They all sit down in this room with Jerome Powell, at the helm and everything else, and they talk about where the projections are going to be from. And so this table right here is something that's very, very important to know. As you will see here with this table here, I want to focus on just this left-hand column right here. So it talks about 2024, 2025, 2026, the longer run, and what they want to get to. As you will see, they want to get inflation down, hopefully to about 2.8%. in the longer run of things. Okay, so that's what the federal funds rate is. Right now, looking at 5.1% as an interest rate, which basically means one cut, because we're at 5.2, we're at 5.25 to 5.5. Now they want to go down to about 5.1, which is about one cut. So they're projecting one cut for 2024. Having more cuts in 2025, more in 2026, and then a longer run 2.8%. Now, the problem is that these are a little bit higher up than what their projections were from March. In March, they were looking at pricing in multiple cuts here. I believe you're looking at about 3 cuts. Now they're down to 1. But the good thing is that in 2026, we're still looking at the same percent of 3.1%. In the longer run, again, a little bit higher. So, they're kind of taking it easy here, being a little bit cautious of it. But that's all right. And then again, as you can see, the PCE data we just kind of covered here. So they're hoping to get 2.6% for PCE and core is 2.8. Now, what's really interesting to note is that if you take a look at the PCE inflation of 2.6 and the core PCE of 2.8, our core one is already at 2.8%, and we're not even halfway through the year yet. So we basically have already hit their projection with 7 months or 6 months left to go, essentially, which is crazy. And the CPE, that's not the core one, is at 2.7, so about 0.1% away from it being at their target of 2.6. So very interesting to note. As you will see, they want to get it a lot down. They want to get these numbers down a lot longer for the longer term, of course. Unemployment, they talk about the GDP and everything else, as you will see here. As you will see, also they also have to talk about the ranges here, and as you will notice between these right here for the ranges, 4.9 to 5.4, 4.6, or just looking at the new ones. These are the new ones, I should say, actually. Is that in looking at the longer run here, you don't see any of these numbers increasing. Right now, again, we're at 5.25 to 5.5. And they're saying even 5.4, which is about in the middle of those two there. So thankfully, we're not looking at any interest rates higher, or the Fed is not looking at interest rates going higher, any kind of hikes being priced in or being considered in for next year or year after that, which is good. But, as you will see, it's going to take some time for our interest rates and our inflation values to come back down slowly as time goes on. So very interesting data here. A lot of things came into perspective here. You can look at the data, look at the charts. This shows all the participants of them voting for the meeting. The good thing is, as you will see, there's no dots up here. These are your interest rates essentially. And as you will see, there's nobody thinking that we're going to have any kind of hike in the next couple of years. That's good. You don't want to have these dots. These are people voting, right? Here's like Jerome Powell, maybe, for example. You don't want to have these people voting up here and looking at potential rate hikes. You have one person here who's probably super bearish about the market and who thinks we're going to need to have these higher rates for longer. But majority of people are looking at rates coming down for 2026, and in the longer run, coming down to between 2 and 4%, which is really good to hear that we're still looking at having interest rates coming back down as time goes on. It's just taking a little bit longer than we need to. And you watch that meeting. If you look at the transcript of Jerome Powell's meeting and everything else, again, I just finished watching it. He made one important thing that I want to note, and I also want to bring it back to the video I made that video I made previously. He goes, I understand it's painful, and it is going to be painful for people in the economy that, are in the lower income areas and everything else because of these inflation values and everything else. But again, he says that, I look at the data, and the data tells me that our economy is still showing strong signs. We're having job growth, we're having lower unemployment still, we're having lower inflation values. So there's a lot of signs that are showing that our economy is still pushing very, very hard. It's not like in a crazy amount of time. But again, at the end of the day, it's just looking at data. Obviously there's opinions and people and everything else, but he's using the data that he's able to collect and he's able to analyze, he's able to interpret with the other people in the FOMC and talking about it going from there. So I bring that up because, again, in my Fridge Financials video, if you're not subscribed, of course, please make sure you subscribe to the channel. We're at 164, which is absolutely wild. My goal was to get to 100 by June, and we're at 164, which is crazy. So thank you so much for your support. This video right here that has over 2,000 views, there was a lot of comments and a lot of opinions backed into it. And that's totally fine. And then again, if you're watching this video and you made this far, first of all, thank you so much. But again, feel free to leave your opinions down below. But the point I want to make here is that, and I made this point to a lot of people who are commenting. I made sure to reply to every single comment that was posted there, unless it's a recent one that I haven't looked at yet. But we're looking at data here, right? And the people that say, you know, the government made up the data, the government's making it up, it's all make believe. I mean, and that might be true. I always just like to hear other people's perspectives with evidence, with data, right? Here's me looking at data. We're looking at CPI data. We're looking at probability of interest rates. We're looking at the market. We're looking at PCE data, which is inflation measures. We're looking at our Fed projections. Like, we're looking at all the numbers here that show this, okay? And the people that don't agree with it, again, love it. I love to be able to learn from other people here. But if you do have your own perspective, please feel free to put it down below. But make sure you show me, hey, Fridge, I don't believe in the government data. Here's what I use for data. If you just come in with your opinion, but there's nothing to back it up with, it's not going to be as credible in my opinion. Okay, we are all entitled to our opinions, of course, but I did love reading people's viewpoints of things. People made some very, very valid points. So for the people that did comment on the video, if you're watching this again and I didn't scare you off yet or make you be like, wow, this guy's an idiot, thank you so much for that. I really do appreciate it. And feel free, again, leave your comments. I want to hear your perspective of things. Again, inflation is still going up. Prices are still going up, but it's slowing down in terms of compared to the previous year, which is what is good because hopefully we're getting to that point we can start to have interest rate cuts and going from there. So thank you so much for watching today's video. At the time of this recording, the market closes in about 2 minutes, and as you will see, we are up 0.93%, give or take. So it's been an awesome day in the market. I hope you guys are making money in the markets. Stay tuned for the next video, and I will see you guys in the next video.